All right, let's talk about one of the biggest brands in the world, Starbucks. You know them, you've probably been there this week. Well, they're rolling out a huge new plan to win back customers. But wow, it comes with a massive price tag. So we're going to dig into an analyst report to see if this very expensive fix is actually going to work.
So let's just get right to it. We've all had that moment, right? Standing there wondering if we should really drop 5, 6, maybe even $7 on a coffee. And it feels like lately more and more of us are saying no. So the big question for everyone from Wall Street traders to you on your morning commute is pretty simple. Is Starbucks losing its magic?
And this quote from equity analyst Ari Feldhandler just nails the problem. On one hand, the company has this really smart, sensible plan to reinvest in what makes Starbucks, well, Starbucks. But on the other hand, that investment is going to cost a ton of money, and it's going to hurt their profits for a while. It's a really high-stakes gamble.
So what is the big problem they're trying to solve here? Turns out, it's a lot bigger than just their prices being a little high.
Here's the core issue, according to this analysis. The company's basic promise to customers, what the pros call its value proposition, has been completely missing the mark. And the result? Falling sales in North America, their biggest and most important market for 2 years straight. You know, in the restaurant world, which is super competitive, Starbucks has really been stumbling.
But here's the thing with Starbucks. You can never, ever count them out. And that's because they have this massive, almost unfair competitive advantage. It's something analysts call a wide economic moat.
An economic moat, I love this analogy, is exactly what it sounds like. It's like the giant ditch filled with water around a medieval castle. It's what protects a company from invaders, or in this case, from its competitors. It's what lets a business keep its edge and protect its profits year after year. And let me tell you, Starbucks is one of the widest moats out there.
Just how wide are we talking? Well, let's start with this number. 32%. That is Starbucks' slice of the entire global coffee and tea market. They are, by a huge margin, the king of the castle.
I mean, just look at this chart. The scale of their dominance is kind of staggering. Starbucks is sitting there at 32%, and its closest competitor, Dunkin', is way back at just 10%. They're not even playing the same game.
And because they're so dominant, they have unbelievable pricing power. The average amount a customer spends in a single trip to a U.S. Starbucks is $9.58. To put that in perspective, the industry average is around $7, and competitors like Dunkin' are under $5.
And another massive part of that moat, their customer loyalty. It's off the charts. Just in the United States, their rewards program has 35 million active members. That's an enormous, super dedicated army of customers who, by the way, spend 2 to 3 times more than people who aren't members.
So the analyst report basically boils all this down to 2 main pillars holding up that wide moat. First, you've got intangible assets. That's the power of the brand itself, that green logo that lets them charge more. And second, a huge cost advantage. Because they're so massive, they just pay less for everything, from their coffee beans to their espresso machines.
Okay, so they have this incredible, almost impenetrable moat, but they're still in hot water. So now let's get to their comeback plan and see how they're going to leverage all these advantages to get back on track.
The whole strategy is called the Back to Starbucks plan, and it's really a multi-pronged attack on the problem. First, they're remodeling 1,000 stores to make them feel more welcoming. Second, they're hiring more people to improve that customer experience. Third, they're using new tech to get service times down under 4 minutes. And fourth, they're shifting money away from constant discounts and putting it into marketing the brand.
When you look at it, this is a really fundamental shift. The old strategy was all about squeezing out every last bit of efficiency and luring people in with discounts, which you could argue kind of cheapened the brand. This new strategy is all about reinvesting in that premium experience. You know, the whole reason people were willing to pay more for Starbucks in the first place.
But, and it's a big but, remember that quote from the beginning? This plan is not cheap. All that new staff, all that marketing, all those store remodels, it's going to seriously cut into their profits for the next few years, especially here in North America.
And of course, this has investors totally divided. Is this big, expensive bet going to pay off in the long run? And that brings us to that classic Wall Street debate. The bulls versus the bears.
So, the optimists, the bulls, they think that new menu items and a better loyalty program will get people back in the door, especially since Americans are drinking more coffee than they have in 20 years. But the pessimists, the bears, they see rising costs for labor and coffee beans as a huge threat. They're also pointing to a lot more competition from energy drinks, and they're worried all this spending is just going to crush profits. So after weighing all the strengths, the problems, the new plan, and all the risks, what's the final verdict from the analyst?
Okay, let's look at the hard numbers. On April 9th, Starbucks stock was trading for about $97 a share. But this analyst did the math and calculated the company's fair value. That's what they think the stock is actually worth based on future profits, at only $83.
And when the price you pay for a stock is higher than what it's estimated to be worth, well, the verdict is pretty simple. The stock is considered overvalued.
Now, this is the really crucial takeaway. The analyst actually loves the plan. They call the strategy prudent and give Starbucks top marks for how it's spending its money. They think the company is doing exactly the right thing for the business in the long term. They just think that right now, the stock price is too high given all the short-term risks.
Which really brings this whole thing back to us, doesn't it? Starbucks is making this massive bet that a better, faster, and friendlier experience is worth more to you than a discount. They are doubling down on being a premium brand. So the question is, in a world where every dollar counts, are you, the customer, willing to pay for it?